Welcome back to Alpha Market Meridian, your daily institutional market intelligence report. I am Eric, and today we are standing on the precipice of a move in the dollar-yen that is going to break the resolve of either the bulls or the Ministry of Finance. We are at 158.81, and the air is thin. Most traders are looking at this chart and they are paralyzed. They are asking themselves, should I fade this rally because the intervention ghost is haunting these highs? Or is this the last chance to board a rocket before the 160 handle gets absolutely obliterated? I will give you the answer. There is one danger zone and one hidden opportunity today, and I will show you both. Stay until the end, because I am giving out 3 exact entry and exit levels you can use right now, including a sniper setup that targets the precise level where the big institutions are stacking their buy-stop liquidity right now. I need you to focus on the instant market verdict. This is not a complicated session to diagnose if you ignore the noise. The session bias is trending, and it is a strong, momentum-driven trend across every single time frame that matters. We are not fading this. If you are short dollar-yen right now, you are fighting the weekly, the daily, the 5-hour, and the 1-hour chart. The computer algorithms are long, the systematic trend followers are long, and the carry trade is alive. The invalidation level for this entire bullish thesis is 158.02. Write this number down in the comments. Right now. I want to see who is paying attention. Type my invalidation is 158.02 in the comments. If we break below 158.02 today, specifically on a 4-hour candle close, the whole structure shifts from a steady grind higher to a messy liquidity grab that could trap late longs and send us spiraling into a stop hunt down to the 100-day moving average. Until that happens, you do not short this market. Let us dive into the technical deep dive, because the narrative here is woven into the moving averages. Look at the weekly chart first. The trend is screaming strong buy. The price is trading way above the 20-week, the 60-week, and the 200-week averages. The 200-week moving average is so far down near the 134 zone that it is not even a relevant anchor right now. What is relevant is the psychological gravity towards 160.00. On the weekly chart, there is no horizontal resistance that matters until we hit the 160.20 zone, which was the multi-decade high before the intervention crash. Price memory dictates that we must revisit that level to test the Ministry of Finance's patience. If you drop down to the daily chart, the picture sharpens. We are sitting on a stack of dynamic support. The 20-day moving average is at 158.20, and the 50-day moving average is at 158.80. Notice something crucial here. The 50-day moving average has just crossed above the 20-day moving average in a slow, grinding fashion. This is a golden cross on the daily time frame, but it is a lagging confirmation of something that happened faster on the shorter time frames. The 100-day moving average is at 157.52, and the massive 200-day moving average is sitting at 154.75, acting like an absolute brick wall of long-term support far below us. The MACD on the daily chart is still negative, reading minus 0.010, but the histogram is contracting. That tells me that bearish momentum is exhausted. We are transitioning from a consolidation phase into a thrust phase. The RSI is at 56.12, perfectly mid-range. It is not overbought, which is the trap. Retail traders see 159 and think, it has gone up too much, I must short it. But the RSI at 56 tells you there is plenty of room to run before any mechanical overbought signals kick in. Now, let's get conversational about how price is interacting with these averages right now. The current price at 158.81 is hovering exactly around the 50-hour and the 5-period moving average on the shorter time frames. On the 60-minute chart, the moving averages are stacked perfectly bullish. The 5-period is at 158.79. The 10-period is at 158.02, and the 20-period is at 158.20. Do you see what I see? The 5-period moving average is acting as the precise magnet for price right now. We are literally tethered to 158.79. As long as we hold above the 20-period moving average on the 60-minute chart, which is 158.20, the intraday momentum is a one-way escalator higher. The support levels are crystal clear. 158.28 is your immediate pivot floor. That is the top of the previous consolidation range. Below that, 158.02 is the backstop, which aligns with the daily moving average and the invalidation point I gave you. On the resistance side, we have 159.12. That is the immediate neckline. Above that, 159.38 is the gatekeeper to 160. I want you to look at the 4-hour MACD. It is flat, reading near zero, but the signal line is curling up. Here is what most traders miss. A flat MACD on the 4-hour chart after a strong rally is not a sign of weakness. It is a sign of a bullish flag resetting. The moving averages are coiling, and the MACD is reloading its energy for the next leg. The 60-minute MACD is even more revealing. We are seeing a subtle negative divergence on the histogram, but price is not dropping. This is a hidden divergence, which in an uptrend actually confirms continuation. Buyers are absorbing every single sell limit order and just holding the line. Now, we need to talk about the fundamental driver and the cross-linkage to the Nikkei 225. Yesterday, the airwaves were silent from the Bank of Japan. There was no emergency statement, no verbal intervention from Masato Kanda, and that silence is the loudest signal you can get. The market interprets a lack of verbal warning as a green light to push the envelope. The 24-hour news cycle was dominated by the U.S. Treasury yields holding their bid, with a 10-year yield refusing to break down. The yield differential between the U.S. and Japan did not narrow. It widened slightly. That is the engine. That is the fuel. The carry trade is not just alive. It is aggressive. To validate this move, we look at the Nikkei 225. The Nikkei is not crashing. It is holding near its highs, signaling that domestic Japanese investors are not panicking about a weak yen. They are buying stocks. This mutual validation is key. If the Nikkei was selling off aggressively alongside a rising yen, we would have a risk-off divergence and I would tell you to fade the dollar-yen. But that is not happening. The Nikkei is stable, confirming the risk-on sentiment. The intervention ghost is real, but you need to understand the mechanics. The Bank of Japan does not intervene just because the price is high. They intervene when the move is disorderly and one-sided. Right now, the move is grinding, orderly, and backed by rising bond yields. The 1 to 2 week directional lean is a slow grind towards 159.38, with a high probability of a stop run towards 160.00. The exact event that would invalidate this thesis is not a specific price on the chart. It is a sudden statement from the Ministry of Finance saying they are ready to act decisively. If that headline hits, we could see a 100-pip flash crash. But until that headline exists, you trade the trend. Most people will click away now because they think they have heard enough. They will skip the execution part. Do not do that. This is where money is made. Keep watching. We are going to build the trade setups from the ground up. I want you to type your US dollar to Japanese yen range for tomorrow in the comments right now. Do you think we stay above 159? Or do we reject? I'm reading them. Strategy 1 is the sniper entry. This is the conservative play for those who want the highest probability of success. You are not chasing this breakout blindly. You are waiting for a successful defense of the 158.28 support level. The trigger condition is a pullback to the 158.30 zone on the 15-minute chart, coinciding with a long wick rejection candle. You need confirmation. A 3-minute close back above 158.50. If you see that, you go long. Your stop loss is hard at 157.95, which is just below the structural invalidation and below the 10-period moving average on the 4-hour chart. That gives you a roughly 35 pip stop, tight and controlled. Your target one is 159.12, the immediate resistance. That is a 1 to 2.3 risk-reward ratio right off the bat. Target 2 is 159.38. When target 1 is hit, you move your stop to break even and let the trade run. This setup is voided if we get a 15-minute candle closing below 158.20. If that happens, the pullback is too deep and the structure is shaky. You stand aside. Strategy 2 is the active trader play. You are seeing the momentum on the 60-minute chart and you want in on the average retest. The entry condition here is a bounce off the 20-period moving average on the 60-minute chart, which is currently around 158.20, but you need to wait for the trigger. The price is grinding, so you set a limit order at 158.40 if the price dips during the London or New York overlap. Your stop loss goes at 157.80, giving the trade some breathing room to absorb a stop hunt below the 158.00 figure. The logic is that breaking 157.80 would mean the momentum has shifted definitively lower. Target 1 is 159.10, and target 2 is 159.80, within spitting distance of the 160 magnet. Once target 1 is secured, you trail your stop manually to 158.50, locking in profit and protecting against any surprise intervention headlines that might vaporize the gains. This is a standard mean reversion play within a strong trend, buying the fear and selling into the extreme greed above 159.50. Let us see how aligned we are. Type your US dollar to Japanese yen range for tomorrow in the comments now. I am reading them. Are you seeing 158.50 to 159.50, or are you expecting a breakdown? I want to see if this community is aligned with the institutional order flow. Strategy 3 is the aggressor setup, and this is only for those who know how to lose small and manage risk aggressively. This is not a RICO for a retirement account. If the price pushes above 159.00 and we see a sudden spike in volume on the 5-minute chart, you enter a momentum chase long at 159.05. The stop loss is brutally tight at 158.75, giving you a 30 pip stop. If it snaps back, you are out instantly. No hesitation. Your target 1 is 159.40, and target 2 is 160.00. The explicit warning here is that this is the danger zone for intervention. You are betting that the algos will drive us into the big round number before any human at the Ministry of Finance can react. If you see a massive, oversized red candle swallow the 159.00 handle, the trade is invalidated. Do not try to buy the dip, just step away. Risk management pulse. Never risk more than 1 to 2% of your capital per trade. Do not carry positions with open risk through high-impact U.S. economic data releases. Stops are non-negotiable. If you ignore the stop loss on a pair that can move 200 pips in a heartbeat due to an intervention, you are not a trader, you are a gambler. To close this out, the single most critical level for the next session is 158.20. If you see the dollar-yen holding above 158.20, the path of least resistance is a grinding squeeze into the 159.40 zone. Tomorrow, we are laser-focused on the US PMI data and any Bank of Japan emergency rhetoric. Any unexpected dip in yields or a surprise verbal warning could be the catalyst for the pullback I described in Strategy 2. Do not miss it. That if you want the full breakdown on Bitcoin and the S&P 500 divergence, and how that risk asset shadow is mapping out a liquidity grab, that video is live now. Check the end screen. I break down exactly why the crypto bull trap might be set, and where the S&P is heading next week. Smash the like button if this analysis gave you a clear plan for the yen. Subscribe and hit the bell for daily coverage of all 8 key assets. I'll see you in the next one. Stay sharp.